recorded this presentation on my 40th birthday in 2009. We were just coming out of the Great Recession from the 2008 global financial crisis. But the topics discussed here and the education provided here is still relevant today, and the study that I reference is relevant today for you as well. So let's go ahead and listen in, and I'll provide that study to you.
We'll review what we're going to cover today. We want to keep this is going to be very high-level information, so we want to go over what is a replacement ratio. When folks say replacement ratio or retirement readiness, we're also going to discuss the Social Security benefit that is projected, and then also target savings rates. This is fairly important, and it's really kind of the core of what we want to go over today. The study from the Journal of Financial Planning that was published provides some target savings rates with some in-depth complex math to try to give you the most accurate savings rate to make you feel comfortable that you're on track to have enough accumulated to produce an income stream in retirement. And they want this information shared with the public, and that's why we're doing this today. I'm going to go ahead and go over the replacement ratio. That is usually how we describe the income that you're going to need after retirement versus the income that you are receiving now before retirement. In the Aon study, and you might see this, this is a copy of the study that was sent out, and we can certainly send you another copy. That ratio was running between 77 and 94% for each person. Typically, 94% is for the lower income earners, to 77% for higher wage earners. Now, for our discussion, we are going to use an 80% replacement ratio, but that's 80% of your gross income minus your savings. So if you make $70,000 and you're saving $10,000 a year, it would be 80% of the $60,000 that's remaining. And that's going to be off of this study from Journal of Financial Planning. Hi, did anybody have a question? Okay, well, let's go on the Aon study. When they're trying to calculate how much of your income is going to be replaced by Social Security versus what you have to contribute, in their study, when we look at this screen, you can see the folks that are making $20,000 a year, generally 69% of their income is replaced by Social Security, and they need to make up a smaller portion of that income that they won't have after they retire at 25%. But you can tell with a higher percentage, they do need to replace approximately 94% of their income after retirement. The higher income bracket you're in, the lower your replacement ratio, but also the lower percentage of Social Security is covered. Again, I want to open up any questions, or if you want to type it in the chat box, please feel free. Now, every year you receive a statement from Social Security estimating your benefits. In that statement, this is a copy of mine from September, there is in small print an important point that in 2017, Social Security will be paying more in benefits than receiving in taxes. Based upon their projections, they actually believe by 2041 they will only be able to fund 78 cents for each dollar that they've promised. Now, those figures are not taken into account when we look at target savings rates. In the study, they projected that Social Security would be fully funded, that you would receive your full benefit, and also to make it simple, because they had to simplify a lot of things, they ran the numbers as if you were retiring at a full retirement age of 65. For most of us, including myself, retirement age is 67. But to simplify it for all of us, they need a retirement age 65. This is just a sheet. When you look inside your statement, you will see projected benefits on if you retire at 62, your full retirement age, mine is 67, and also if you wait to retire till the age of 70, which of course gives you the higher benefit. When you go to try to find out how much your Social Security is going to be, and the reason I focus on this so much is because you pay, of course, 6.2% of your income already into Social Security. Your employer also pays in 6.2%. So you have a great deal of savings already going into Social Security before we talk about your own outside savings. And it's important to know what your estimate might be. So there's a couple of websites listed here for you to research your own personal Social Security replacement. Now let's go to what you're saving. This is really important on the target savings rates. In order to maintain your standard of living, most folks need approximately 80% of their pre-retirement income. If you speak to folks that have retired, they like to maintain their standard of living. You don't go from living a $100,000 lifestyle to living a $30,000 lifestyle. We're not designed to do that. We want to maintain it, generally speaking. So you probably live the lifestyle based upon your income. When we look at these target savings rates, again, they made several assumptions. They did assume that you're going to retire at age 65. You have one wage earner, your spouse is 62. There are several assumptions in there which you can read in the study, but I think it gives us a nice place to start to have this conversation regarding your target savings rate. What they did on the average rate of return was saying they took the average of target date funds, the asset allocation used in target date funds based upon your age. They used actually 3 target date funds that are in existence and used the average asset allocation between those 3 and said if you invested in a target date fund at whatever the target savings rate is, you have a 90% probability of having enough money to retire at the age of 65, purchase an inflation-indexed annuity that produces that income stream. Because if it's inflation index, it's going to keep up with inflation, of course, and then an annuity which would last your entire lifetime. And that's based upon mortality tables. Let's go on to the target savings rates themselves. So for those of you aged 27 years and younger, this is what we're looking at for target savings rates. And I apologize, I do not know the ages of the folks on the phone call or on the webcast. So what you do is you find your age. So this, we're just looking at people age 25, so you could say anybody 27 years and younger. Find the closest income bracket to you, 20,000, 40,000, 60,000, or 80,000, and that would be your target savings rate. So if you were 25 years of age, making $20,000 a year, and you're starting to save, your target savings rate would be 5.8%. Now, what if you already have savings at 25 years of age, which huge kudos if you do. For every $10,000 you have saved, the right-hand column is you take your target savings rate minus that, in this particular case, would be 1.6%, so 5.8 minus 1.6. If this person already had $10,000 saved for retirement, that would bring it to what, 4.2% would be their target savings rate. Now, that would assume that they would save from the age of 25 to the age of 65, and then they would have a 90% probability of having enough income saved to purchase an inflation-indexed annuity to supplement Social Security and replace 80% of their income. For those of you aged 28 to 32 years of age,
the deduction column, does that mean for every 10,000 you have, you take it off?
That's correct. So, yes, so for example, let's take an example here. You're age 30, you're making $40,000 a year. Your target savings rate, if you have nothing saved, would be 10%. Let's say you already have $20,000 saved. So it would simply be 2 times 0.79, which is 1.58. So we would take 10 minus 1.58, which would bring that person's target savings rate to 8.42. We would get a little bit older here, age 35, which is interesting. This is kind of a critical point when you read through the study. And so let me just read Janet's comment. Michelle, can you clarify that the savings rate is inclusive of any employer match? Thank you, Janet. Very good comment. Exactly, yes. Let's say, for example, I think that last person we were looking at, their target savings rate was 8.42. That is a total target savings rate. If your employer is giving you money, either as a match or just as a contribution, that would be included in the 8.42. So in an example, let's say your employer is giving you 3%. That would mean the person would simply, their target would be to be 5.42. with the 3 for a total of 8.42. Thank you, Janet, for clarifying that. So on the folks who are age 35, if you read the study, you'll notice that this is kind of a turning point for those folks between 35 and 40 is a critical time to start saving if you've not started saving already. And if you look at the savings rates, 8.6 up to 17.6%, they're reasonable. They're within a reasonable range of being able to, because you have to reduce your lifestyle today in order to save that money for the future. And we get to the higher savings rates once we get past 40. So here's for the age bracket of age 40. Again, a different income bracket, so please find the one closest to you. The target savings rates running, again, from 10.2 up to 21%. That really hurts if you have not started saving yet at the age of 40 and you're making, let's say, $80,000, 19.8%, that's a high savings rate. So that will definitely impact your lifestyle if you start saving 20% of your pay at that point. And the deductions are not quite as high, so you may have $10,000 or $20,000 already saved. But on this point, let's say you're 40 years old, you have $40,000 saved already. 4 times 0.42. For a person making $80,000 a year, I'm just going to do 19.8, 19.68. Their target savings rate is still slightly over 18%, which is fairly significant. The average savings rate, as you know, in America is approximately 7%. So anytime we're getting over 7%, we're asking people to go outside their comfort zone. Let's keep going up in the ages, because we may have some folks that are a little bit older than 40 here. For those of you age 43 to 47, again, find your income bracket. And this is for folks that are age 45, your target savings rate, and then also note the deduction for each $10,000 that you already have saved. For those of you age 48 to 52, again, age 50, find your income bracket, your target savings rate. So this is, when you look at these target savings rates, I know when I look at these, I think, wow, that's fairly substantial. Also note down your deduction for each $10,000 already saved. In the question and answer time period, we can always go back to these slides if you miss any of the numbers. And it's also in the study that was sent to you. Age 55, for those age 53 to 57, find your income bracket, your target savings rate, and the deduction for each $10,000 you already have saved. Okay, the final table here for those age 60, which is, I doubt anybody who's age 60 on this call who has not saved anything, because the folks that generally join these calls are the folks that are already saving and are actively involved in their retirement, but find your savings rate and the deduction for each $10,000 already saved. So if you are age 62 or higher, of course, please try to work until you reach your full benefit. We try to encourage everyone, we are living longer, to try to work as long as possible and not draw on your Social Security. And also find a professional advisor to help you. There's nothing better than individual investment advice that's specific for you in your circumstances. All right, I just want to go over this again. In the study that was sent out, what you'll find is this table 6, which is a great check-in. So if you want to say, am I on track or am I falling behind? Where am I? Am I where I need to be? So if this is based upon a person, if you had started saving at the age of 35 and followed the target savings rate from the study, which is different for each income bracket, so I won't say any specific number, but it runs from 8.6% up to 17.6% in the study. You had a 50% chance of being at the dollar amount, having already accumulated the dollar amount based upon your age and income of where you are today. Now, the market, as we all know, the market took an enormous dive last year, which is a market, any one of the market scenarios. So you might be under panel B, you'll see that the dollar amounts are lower. There was a 90% chance that if you followed their savings rate starting at the age of 35, there's a 90% chance you would be at the dollar balance under panel B. Considering the market that we had in 2008, If your dollar amount is closer to the dollar amount listed in Panel B, I would feel comfortable with that because it was such a dramatic decline in the market last year. So on the right-hand side, it just says that they did use Monte Carlo simulations. They used 2,000 scenarios. 1,800 scenarios, you would have more money in the end, and you would be able to have a higher retirement income. That's the chances of it. But there was always a 10% chance you would have less income. And so they're always trying to make sure you have more than enough retirement income. Some of the studies that are out there use that 50% probability. I think it's better. The Aon study, I believe, was using that, and some of the target savings rates in the Aon study are lower. It's really important to take into account that you want the best chance possible to replace your income. So today we just went over the replacement ratio, the benefits from Social Security, and also your target savings rate. From the authors, they just want to say there are a lot of variables that go into their calculations when they're putting together this presentation, and that if you want anything truly specific to you, that you should have an individual advisor help you with that. Well, again, this is our first national webinar. I hope it was useful. I hope it was good information. I am taking feedback if you'd like to do this again on another subject matter, maybe investments, maybe target date funds, or asset allocation. I'd be more than happy. We want to try to encourage this and give you the best information possible. So please give us your feedback or give it to your HR director, and they'll get that back to me. And I want to thank you very much for your time.